Well, welcome everyone. Thank you for joining us. We've been excited about this webinar here. When I think back to the past few years, it's kind of hard to imagine that a few years ago, if we would have spoken and had known that we would go through a global pandemic followed by supply chain disruptions, rising unemployment, high inflation, then a couple years later, like we've not seen in 40, 50 years, a major war, the fastest 35% decline in the equity markets in 2020 that we've ever seen, a subsequent recovery that way, a 25+% decline in the equity markets in 2022. Third time in history that both stocks and bonds have been down in the same year in 2022. Yet we fast forward and here we are sitting with all-time new highs in the market. It would have been hard to believe, but yet here we are. And we come into 2024 with a new headline, which comes up every few years. This is an election year. And so we start getting questions and asking questions ourselves of how have the markets typically performed historically in equity market in election years. And does the market even care who is in office and who is controlling the House, Congress? And so with that said, I'm grateful to have a longtime friend and longtime partner of our groups, Chris Jenkins, Capital Group, here with us today. So Chris has been in business for 30 years. Capital Group, you might know as American Fund. So Capital Group does a lot in the financial services and investing world. They manage over $2 trillion of assets for families and for shareholders, but they do a large part of that through their mutual funds known as American Funds. And so Chris and his group are really on the front lines of talking with the end companies where they are deploying this capital, talking with the biggest publicly traded companies around the globe about how they're thinking about the election year, how they're taking higher interest rates, what they're seeing and how they're adjusting to continue making earnings and return profits to shareholders like you. And so Chris, thanks for joining us. You know, in the nearly 100-year history of Capital Group, you all have seen a few market cycles and you've seen a few elections. So we figured that you would be a great partner to have on here to kind of go through and talk about all this. And before Chris gets going, there's a Q&A, should be a Q&A at the bottom of your screen. Please submit any questions. There's no silly question. I can guarantee you that if you're thinking it, others are thinking it as well. So go ahead and ask it. And we set it up where nobody can see the questions except for me. So I'll be paying attention to the questions. And after Chris is done, we'll come back on and work through as many of these as we can. So again, thank you for being here. And Chris, thank you for taking time to join us. And I'm going to hand it over to you.
Excellent, Drew. Thank you so much. I think just to feed off a reference you made there that in our nearly 100-year history, we've seen a lot of elections. But I want to start with just an acknowledgement. I'm not sure we've seen an election season like this year. And here are the numbers. There's 76 countries. So roughly 4.5 billion folks are going to vote this year on a global basis. Taiwan had their election last month, and a pro-independence candidate won that, which may disrupt a little bit or aggravate some already tense relationships with China. March 17th, mark your calendars there. I don't think this will be a shocker with Vladimir Putin up for re-election in a few weeks as well. So on a global scale, it's happening, but all eyes are focused on November 5th here in the United States, as you have clearly the presidential race that will be happening. You have 34 Senate seats up, 435 members, which is all House of Representative seats are going to be up for grabs, and numerous state and local elections that are happening as well. So buckle up. It's going to be an interesting season. But I think your reference, and I kind of want to start with this, and I'm going to show a couple of things here, is an important one, which is how are large investment institutions thinking about this? I think there are four things that I kind of want to start with, just to paint a little bit of a picture of topics that are kind of bubble up, that things that are just going to be around us for the next next 6 months or so. And we'll rattle those off, and then I'll kind of walk through a little bit of this history lesson. What did we learn from past elections? So let's start with a couple of things that are bubbling up right now. And number one, as we start to think, and as we're talking to companies, certainly here in the U.S., but around the world, as they contemplate what this may look like, it's really driving back to one theme, and this probably won't surprise any of us on the call today, and it's still the economy. And maybe just to paraphrase James Carville's working on that phrase in the 1992 election, it's still the economy, stupid. It's all about economic growth. That's mostly what's going to drive elections. And as we're meeting with folks right now, a couple of themes that have bubbled up. Number one, GDP currently is far exceeding most expectations that people have. Inflation is off from its high, 9.1% a few years, and feels like that's a little bit under control broadly. And importantly, Drew, as you referenced, the stock market is effectively at an all-time high. Day here and a day there, we're probably going to hit 40,000 here for the first time any day now. And so from that perspective, the narrative seems to work quite favorably. But I think we're also hearing, well, hold on a second, food prices are high. So while inflation may be under control, the real inflation, we're feeling it at the grocery store every day. So how are investors, or importantly, voters going to contemplate that? How about housing? Unaffordable housing is all the rage, certainly for those of us in the Middle Tennessee area, and we have elevated rates. And it's a lot of first-time home buyers or home buyers in general are questioning, oh my goodness, how can this be sustainable? And I think any political conversation is not complete without acknowledging we have skyrocketing national debt. You're talking $34 trillion of federal debt, unlike anything we've seen before. And so I think that's weighing on companies and certainly investors. Now, second thing that's bubbling up a lot is the decision-making process for the election this year. And a handful of battleground states, and you can even go a little bit deeper in that and say maybe just a handful of congressional districts are going to choose the next president of the United States. In fact, if we go back to 2020, 45,000 votes in 3 states were the difference. Very similar to what happened in 2016 as well. So we know that a few folks are really going to manage this process for us all and make these big decisions. The red states will stay red, the blue are going to stay blue. It's those purple states, and again, some of these purple districts that are probably going to decide this. And I think we have to be careful, and your candidate of choice, I think we have to be careful as we start to hear any reports of a political narrative as it relates to polling. And that's going to be very complicated. And again, it's going to come down to a handful. And again, our estimate this year, maybe 100,000 people are really going to decide this. Third thing that we're thinking a lot about and talking to a lot of companies about, this is a big one, which is tax policy. That's going to be a big part of the narrative in the conversation this year in the election. We have the sunsetting of the Tax Cut and Job Act of 2017, the Trump tax cuts, which really reduced the tax burden for taxpayers to about $1.5 trillion over kind of a 10-year period, which we're coming up against. Now, some have argued that's been really good economic growth and it's driven a lot of this. The other side of that is back to we have $34 trillion of debt. So I think there's going to be a lot of conversations with the expiration of that at the end of 2025 of what tax policy is going to look like. I think that's going to cause a lot of conversations. But importantly, I'll share my screen here. With those three behind us, what we're hearing from companies is we can't let politics derail a good investment plan. And history's filled with good examples. We're going to share some of those today. And I think, Drew, your reference, I don't think that the stock market cares who's in office, but think of this as some thoughtful responses to important conversations. We're not in any way dismissing any of the political narrative that's out there. It's meaningful. It matters. And but we want to view it through a little bit of a historical lens. Now, as Drew referenced here, as I'll scroll through here, and we'll provide this to you. This is, and again, you can see, you can guide2elections.com. We own that. We've done a lot of research over the last 90 years, 23 election cycles. And today's conversation, I really just want to dig a little bit deeper into what the research has revealed over the last 90 years as we've looked at stock markets and industries. And you'll see where this conversation is going to go. And, I also want to start and acknowledge in any conversation like this, anything I say or anything that my firm publishes, I want to draw a clear distinction between analysis and advocacy. Our job is to provide analysis of the world in which we see it, and in no way advocating for one party over the other. At the end of the day, we're an investment management firm whose sole responsibility is to deliver the best possible return for investors and improve their lives through successful investing. So I don't want you to take anything that I share or others as we share these conversations over time is anything towards an advocacy position. It's all analysis. And I also want to offer up, and then I'll kind of share the highlights of the research, is I'm reminded of the great investor, Sir John Templeton, a proud native Tennessean, who was knighted when he lived in the Bahamas. But Sir John Templeton was fond of saying that the four most costly words in investing, and I will propose the four most costly words of investing in an election year to add to it, are those four magical words: this time is different. So I want that to hang over us, because I've heard that in many elections going back in my 30 years in this industry, is to suggest, well, it's different this time. And, maybe personally it may feel that way, but it's hard to make too much of a claim that the data supports that. So here's what we've learned in our research and our time together. I'm going to dig into each of these four topics. First, we want to sort of acknowledge, in the far left-hand side as you're looking at here, is that stocks have gone up regardless if it was red or blue. Democrat, Republican, stocks have found a way to go up. So we're going to dig a little bit deeper into that. We're going to talk about the primary season. We're in the midst of that now, and it tends to be volatile. So we'll give a little historical context to that. That volatility has often led to investors going to cash. We're going to explore that a little bit, and then showing why that may not be the optimal decision as we move forward. So with that as our quick agenda here, let's get into some of the details of this. So again, let's tackle the big one here that seems to hang over us every year. If you're a Republican and you think Democrats have been bad for the stock market, if you're a Democrat, you think Republicans have been bad. And what the evidence shows is that stocks have trended up in a very technical sense, up and to the right on your chart here, whether a Democrat or Republican won the White House. And for history to reveal that the somewhat political indifference of companies is an important message that we need to deliver. Now, I'm not suggesting policies don't matter. There are certain industries that do better. We'll look at that here in a moment. Maybe certain sectors that may be poised to do better in different administrations. But this is the S&P 500. This is a broad index. And we know, going back to 1933, again, over 23 different election cycles, that one trend has been clear, and that's hating the U.S. government has been a lousy investment strategy. Don't bet against the U.S. government. Don't bet against the U.S. consumer, more importantly. And related to that, don't bet against U.S. companies, because they find a way to do well. So let me bring this to life just a little bit, because this is sort of a logarithmic scale. And I'm going to show you that as we look back at time, again, going back to 1933, that there have been the best four markets, just for context: two were Republican, two were Democrat. So on the chart, again, may not be easy to see because of the logarithmic nature of the scale, but the best period for the stock market, again, red and blue. So blue was the number one period for the stock market, and that was the Clinton administration. Stock market was up 210% during the Clinton administration. So that may surprise some of us as we think back over that time frame. Second best performing market, going back to 1933, was actually the Obama administration, up 182%. Number three was Eisenhower, going back to the 1950s, up 129%. And the fourth best performing stock market was the 8 years of Ronald Reagan and the 4 years of George Bush. Market was up 117%. So not only cumulatively has it not mattered, but even individually, markets have found ways to do well, whether it's a Republican or whether it's a Democrat. I think that's an important narrative for us as we contemplate what's happening right now. Again, Drew's referenced earlier, who would have thought that after all we've been through in this, over the last, call it 4 or 5 years, that the stock market is on a tear at an all-time high. So it's a good lesson for us to be mindful of. Second thing we want to look at is what's happening in the midst of an election year. Now, I'm conscious I did make the phrase, the four most costly words, or this time it's different. So I may enter something into the conversation here that we haven't seen since 1932. But here's what we would anticipate. So you have two lines on your chart here. The top line are non-election years. So the darker blue line, the lighter blue line would be during election years. And here's what we know. In non-election years, the markets tend to act somewhat, we'll call it normal, in the first 3, 4, 5 months of the year. We'll call that the primary season. But what we've noticed, and history has shown, during the primary season, there tends to be a lot more volatility, and then kind of we're off to the races. So to give you context, from that May at the end of a primary season, 1 year forward, during election years, markets tend to be up about 11%. During non-election years, up around 5.5, 5.7% to be exact. So we do anticipate once things settle down and we know the nominees, now we know that's a little bit, when I introduced this idea of maybe this time is a little bit different on this topic, is we have pretty good clarity today of who the nominees are going to be for each party, which we haven't had that in the history of capital markets to suggest that we know exactly who it's going to be because of the situation we're dealing with now. Now, where this could get a little interesting is, do we extend that blue line and maintain a volatile market through the convention season this summer? So that's something that we're going to keep our eye on is, are these really the nominees? And again, we don't need to get into the political discussion of that, but I do think the market wants to consider is, are these going to be the two presidential candidates? Can something happen between now and the convention for the obvious reasons that are hanging over? So maybe that May period extends a little bit longer this year, but we would anticipate, again, a reasonable high degree of volatility as history has shown us. One other area that is important that we want to explore here a bit is there research or data that suggests that there are certain sectors that have done better in election years. And so help you make sense out of this chart, we took all the different investable sectors in the S&P 500. Dark blue is the 1 year before the election. The light blue is the 1 year after the election. The dot will be the average. And I think what's been revealed to us is three broad industries generally have a lot more volatility, and you could propose those tend to be politically oriented. And again, we would anticipate that to be the case this year. And those three sectors are energy, financials, and information and technology. And I think as we think about that, it kind of makes some sense to us that certainly energy and financials tend to be politically driven, right? What is the oil production going to look like and its impact? What are some of the environmental concerns that may have positive or negative impact on the energy sector? So because of that, it's common for us to see a lot of volatility pre and post election. Say it differently, if it's negative, it tends to bounce back pretty sharp. And financials would be the same way. As we start to think about economic activity under different administrations and the impact that could have on interest rates. We know the impact interest rates have on bank stocks as an example. So not surprising that we see a lot of volatility in financials. And technology is the newer one. Over the last several election cycles, we've started to see a lot more volatility. And that's driven by the kind of the global nature of U.S. technology companies and the impact that some policy decisions have, some antitrust questions that bubble up could have on technology companies as they try to expand outside the U.S. and any acquisition challenges that they may have inside the U.S. as they scale up. So that generally brings in a little bit of volatility. But outside of those three, we would say that they kind of mirror, the ups and the downs kind of look alike, and not much that we could run into. I will say that rarely, if ever, have there been proposals in or policy decisions that are hanging around during election season that come to fruition that absolutely destroy a sector. And I think that's an important thing for us to consider, that really never happened. But again, we often respond to that during the election period. And then finally, what mistakes and clear, I'll let you take this chart in. This is money flow, year 4, which is where we are. Year 4, a lot of these concerns and individual concerns that we have over the future of elections manifest themselves in the 4th year. Why? Well, it's the midst of the election year, and the narrative is quite strong. And what we've noticed is that is election year, the 4th year of an election cycle, is the worst year for inflows into stocks. And it's generally, the 3rd year, is with that. And I think that was influenced by last year with higher rates. But the 4th year, a lot of money is going into cash. So you're seeing less money going into stocks, more money going into cash. But reset that to year 1, so it'll be the year following the election period, all that money goes back into stocks. So we just know that investors get a little bit nervous and start to contemplate moving into cash. But rarely is that a winning strategy. And this brings that concept to life. So what do we do? With all of this as backdrop, what's the best strategy? So we kind of contemplated 3 broad strategies going back to 1932. So we said, well, what if we stay fully invested? What if we continue just to maintain a dollar cost averaging strategy by contributing to our 401k plan in this example? And then what if we just get nervous about how the elections are going to do? I go to cash and I wait until after the election to invest. And what the data shows, this is the best strategy of staying fully invested. Again, every election cycle, it's a 4-year period. The best idea was to stay fully invested. Second best option was consistent contributions. And only 3 times out of 23 was the best strategy to sit on the sidelines during that 4-year period. So the research to us is pretty clear. We tune out the noise. And Drew, that's where I started this conversation. We're well aware nothing can derail a long-term investment plan like the conversation that comes in to election years. But we know elections have had little impact on long-term investments. Markets, again, summarize some of this, will be volatile. Sitting on the sidelines out of fear and uncertainty is rarely a winning strategy, but stay invested, contribute to it, and things tend to work out pretty well. So with that, that's the end of my formal comments. I know we have plenty of time for some Q&A, Drew, so feel free to go in any direction you want. As I'm sure some questions have come in, they normally do in these conversations. So I'll let you take it from here and see what's on their mind.
Thank you, Chris. And just a reminder, everyone, you can submit questions at the bottom. I'll be the only one that sees it, so feel free to fire away. But thanks, Chris. It just reminded again, I think Buffett was quoted as saying that the market is the most efficient mechanism of transferring money from impatient investors to patient investors. And it continues to be the key. And I'm just struck that the market really is apolitical. It's just owning great companies matter. And these companies figure out ways to grow profits regardless of who's in office. So a couple questions that have come in here. One, just on the interesting idea that at the end of the day, there are people at American funds, for instance, portfolio managers that are deploying capital. They're deciding what companies to buy, to put more money in, to take money out of. And so curious on how they remove their political bias from those decisions and just invest money with the goal of earnings and growing stock value.
Yeah, it's a fair question. We don't want to dehumanize the decision makers. Certainly in our firm, we have 400 around the world that are making investment decisions. And I think a couple of things I would think about there, because again, I think they are humans, and like any large organization, I can show you clear evidence of folks that will have a political bias one way or the other. And so I think two things. One, I do think the global nature of what we do matters. And again, I made a reference to 4.4 billion people are going to vote in an election this year. It's bigger than a U.S. story, and roughly for us, half of our investment professionals rough around here are outside the United States, and they're probably not thinking nearly as much about the impact of what's going to happen here in the U.S. They may be more concerned about what's happening in Taiwan. So I think acknowledging the global nature, but the second, and I think this is the big one for us at least, is our investment professionals are compensated over an 8-year period. So decisions that they make will extend well beyond one presidential cycle. They're not going to be compensated over a 4-year period or a 2-year period or an election cycle. It's an 8-year period, and I think we made that decision in 2008, coming out of the 2008 financial crisis, to align portfolio manager compensation to long-term objectives. And I think that's made it a lot easier to remove any of those short-term biases by saying, hey, we're really going to compensate you over long periods of time. So the global nature and the 8-year periods, I think, make that a lot easier, and to recognize, I guess we should say it, we're in trust to provide reasonably good outcomes for investors, and without letting our own emotions get in the way. Because again, I think they're privy to the same data I'm privy to, if not more. Market's going to get this wrong no matter what we think anyway. So make it a little bit easier to think longer term.
Sure. Okay. Thank you for that. And as you were going over your presentation, you hinted at just some potential tax changes that could be coming the way. So I'm curious for you to flesh out a little bit more kind of what you're referencing to, and then as investors, tax impact on investment decisions. What do we do with that?
Yeah, that's going to be the big one. I think as we start to balance out this year of the political conversation, I think balancing this $34 trillion federal budget debt there, federal debt that the United States has, which is a percentage of GDP, is only forecasted to get bigger. So we got to start having real honest conversations about that. And we're coupling that right now with the expiration of Trump's tax policies, the Tax Cut and Job Act of 2017, which again many will argue was incredible fuel. So how do we deal with these, right? But as it stands today, I think we have to be careful, and certainly put your planning hat on here, Drew. I think we have to be careful trying to make decisions about what we think would happen. But as it stands today, the Tax Cut and Job Act, if Congress does nothing, and I would love to engage in a debate on anyone now that thinks Congress will do anything on any topic right now. But the easy path for them is to let the Tax Cut and Job Act of 2017 just expire. Now, I'll remind you, most of the expiration we will feel. The one big permanent that was part of that was the reduction of the corporate tax rate. So that's still out there. But for individual taxpayers, everything is due to sunset back. So what does that mean? That means that the higher marginal tax rate is going to go up. I think the big one for a lot of families that they're dealing with right now is the lifetime gift tax exemption is going to get cut in half. So I think right now, maybe at the end of next year, it'll be close to $14 million per individual that can be passed free of estate and gift tax. So $28 million for a family. That's a lot of money, but that's due to sunset and get cut in half. Indexed up. So call it $7 million for discussion's sake, which is still significant money. Well, we're not acknowledging that. But there's a lot of families who are going to feel that. So there are some planning opportunities there, Drew, that we're seeing. Let's take advantage of these high levels. Again, they may go up. So any planning we do now doesn't hurt us. But if it goes down, we're going to wish we could take advantage of that. So I think some gift and estate tax conversations are very real right now. We're seeing those. There's some real technical ones that if you get paid in instead of stock options, the alternative minimum tax is going to come back in. Well, if you have stock options, that could trigger AMT. So there's a few of those that I think are hanging out there, and decisions that we want to make. Let's start contemplating how can we make those. We don't necessarily have to make the final decision, but start to get ready, particularly as it relates to that exemption amount. That's a big one. I think we'll see what happens. What do you think?
Yeah, so piggyback on that. If the reality is potentially a tax environment where tax rates are going to go up, then tax-aware investing matters a lot. Asset location in terms of where you're owning certain investment assets matters a ton. I'd say how you are investing. There are ways to invest and own great companies that are not very tax efficient outside of retirement accounts, and there are ways to own great companies that are very tax efficient. And tax loss harvesting is going to matter more than it ever has. And charitable giving and things that we can control. And then to your point, Chris, that for certain families that are at a potential taxable estate situation, we've got kind of a ticking clock right now. We've got a year and some change before that clock strikes, and we lose out on the ability to shelter a considerable amount of money tax-free for multi-generational purposes. So these are important things you or your family to pass along, to be speaking with advisors and attorneys about what to do there.
I think it'll be a bull market for attorneys next year. Surge pricing, if you will, like an Uber. Like you start now.
That process early. That's right. Chris, let me ask you this. So if we acknowledge that the market's apolitical and we basically kind of throw the election out the door, let's assume this is not an election year. You hinted about this earlier, just kind of about some larger themes that are playing out in the market. Things like how's GDP actually doing? How are companies and earnings actually going? Just looking at the actual market forces at play, and of course, interest rates and inflation. You just take these high-level themes that do impact the markets, and how is Capital Group thinking about and responding to the big themes when we put the political the political stuff on the shelf for a second.
Yeah, I think from a broad general context, I think there's a reason why the markets are doing well, and I think we have to acknowledge that broadly that the media is certainly hyping up the Magnificent Seven stocks. We've heard a lot about Nvidia. None of us knew what Nvidia was a year ago. Now it's all we talk about. In fact, Jensen Huang, the CEO of Nvidia, was just in our office to talk about. I'll use that as an example here, though. He was just in our office to talk about how we, as we're over the years have been a significant shareholder and close to that company, and how we need to be thinking about sort of this idea of artificial intelligence right now. So I think that's a good example of a macro theme that's sort of hanging out there. Look at Microsoft's success, clearly Nvidia. What's Google going to do or not do? They're having a couple issues in the last few days. So I think there's some big mega trends out there as it relates to sort of this continued technology transformation in society that is highly investable, highly scalable, certainly as you begin to contemplate outside the US. So I think that technological innovation, again, earnings are real. I mean, look at Nvidia, and again, not to keep using them as an example, but this is not just stocks are going up. Earnings look really strong, and I think that's supporting it. You look at some of these healthcare companies. If we talk about the Magnificent Seven, we have to turn our attention to the healthcare, what we call the skinny two, which is Eli Lilly and Novo Nordisk, and what they're doing with weight loss management through some of their historical diabetes drugs. Like, that's a highly investable world from a healthcare perspective. So I think when we look at technological innovation, a lot of the healthcare innovation, there's some wonderful investment opportunities that are hanging out there. Here's another one. I have the numbers in front of me, and again, this may bring in a little bit of the political narrative. U.S. bills that have been passed in, call it, the last 6 or 8 years broadly. Let's say the Trump Biden, and probably more under Biden than Trump, but not exclusively. $1.4 trillion of fiscally induced CapEx, so capital expenditure spending, from 2023 to 2030. That's what we have left to spend. And I'll give you some examples. The energy and grid infrastructure, $316 billion. Airports spending $157 billion still left to spend. Rail and public transit, $141 billion. You get the feel for it. So I think that, again, we could argue, well, that's government money pushing the companies. Yes, it is. But back to GDP growth, there's a reason why stocks are at an all-time high and earnings are good, because a lot of money is moving into the marketplace. And again, let's put our $34 trillion federal debt hat back on and say, all right, we got to pay for some of this stuff. So, but the market's discounting a lot of that right now. I think they're under the impression that we have this permanent prosperity and markets will continue to grow. And again, I still think we want to be careful. We're not saying that everything's rosy and it's a perfect environment out there. We still want to have discernment in decision making that we have. I think the best news from an investment perspective on a big theme is you can finally make money in the bond market again. And so for older investors, cash is finally paying you something. Again, not as an investable asset class, in my opinion, but certainly if you have a short-term need over the next 2 years, you're at least making a little bit of money on that and not having to take long-term oriented risks. So I think there's some interesting opportunities developed, and it's probably a pretty good time to make sure, and I get you, I know you guys do a good job, but let's make sure that we're aligned and taking advantage of these. And I think I'm probably speaking to some of your folks on the call today who's friends and family members that may not have been as well positioned for what lies ahead.
Yeah. Well, it seems like this soft landing that everybody is hoping for is potentially playing out. Maybe too early to call as of yet if a recession is going to be avoided, but unemployment's low, wage income's up, discretionary spending that drives a lot of profits. There's a lot of good data points, I think, from a macro level that we point to support the current values and continue growth from here.
Yeah, that's right.
Yeah, and I rewind also back to a period. I know you've often said, Chris, that history doesn't repeat itself, but it rhymes. And I look back to the market returns that happened in the 80s following a high inflation environment, and both equity and bond markets seem to react pretty well in that type of environment. So I think that's what a lot of what we're hoping for would.
Yeah, and that was that Reagan Bush fourth best market we've ever had was in that period coming out of that. So yeah, it's a good call out, good reminder.
Okay. Well, hey, thank you for joining us, and I know everybody on the call here, thank you. And the most important thing is we invest money based on a plan. We don't invest it based on here's some money and just go make as much as possible. Everyone who's on the call, we invest money based on your financial plan. And so the plans that we have run have already baked in the fact that there are going to be normal market cycles. There are going to be corrections. I mean, market ups, market downs. We're going to go through election cycles. We've kind of baked all that in. And so if you want to revisit any of that at all about how we are thinking about portfolios given an election year and in light of your overall plan, we're here to help and meet and go through all that and update your plan. The good news is that every plan that we're looking at this year looks a lot better than last year because, equity values are up anywhere from 15 to 25% from where they were a year ago. So we got a lot of good wind in ourselves, and we'll hope for a great market this year as well. As Chris shared, historically speaking, most of the time in election years, the majority of the time the market's actually up for the year. So, well, thanks for joining us, Chris. Thank you for taking time out of your busy schedule and all the great work that you and Capital Group that you all do to deploy cash on behalf of clients and to invest wisely for long-term growth. So thank you for being here.
You bet. Thank you. Appreciate the opportunity. Take care.
Take care. Bye-bye.